this week's update. Markets end 2017 on a high. More volatility is expected at the start of an uncertain 2018, and UK growth is set to slow further. 2017 ended with a bang on global stock markets, with new highs recorded on the last trading day of the year. That was good news for investors who've now enjoyed nearly 9 years of broadly rising markets. For those with long memories, however, it was an ominous reminder of the year-end high for the UK stock market in 1999, which proved to be the high water mark and wasn't reached again for 16 years. The consensus view is that we're not rerunning the dot-com bubble this time. Certainly, there's an absence of the market euphoria which marked the earlier market high points. Interest rates remain low, and there is a synchronized upturn in global growth. So with luck, it's a case of history rhyming rather than repeating itself. At home, the FTSE 100 and the FTSE 250 both ended the year at new records. The 100 index finished at 7687.8, up nearly 8% from the closing day of 2016. The 250, meanwhile, was nearly 15% ahead at 20,726.3. The outperformance of the 250 was one of many surprises last year, as the conventional wisdom said that UK-focused mid-caps would fare worse than international blue chips in a year of slowing growth in the UK and a weaker pound. The best performers in the home market included house builders Persimmon and Berkeley, as interest rates stayed low throughout the year. Both builders had been hit hard in 2016 as investors feared the Brexit vote would hit the UK housing market, and both rebounded by more than 50% last year. The FTSE 100 was also given a boost by its strong weighting to the energy sector. The rise in the oil price from under $50 a barrel in the summer to nearly $70 by year end helped the likes of BP and Shell. Oil's strong run continued this week, with Brent rising to its highest level since May 2015 on the back of rising tensions in Iran, where days of anti-government protests have resulted in several deaths and hundreds of arrests. At the other end of the scale, British gas owner Centrica fell by more than 40%, as it looked likely that the government would push through a price cap on energy bills. ITV and WPP were other high-profile losers, as companies reined in marketing budgets as inflation and stagnant wage growth ate into consumer confidence. Across the pond, the US markets did even better. The main S&P 500 benchmark rose by 19% to close at 2673.6. The Dow Jones, a less useful but still widely watched measure, rose by 25% to 24,719, while the tech-heavy Nasdaq index had a stellar year, up 28% to 24,719.2. US stocks were beneficiaries of the global upturn in activity and growing expectations as the year progressed that President Trump would achieve at least some of his proposed reforms, notably the tax cuts that were narrowly passed by Congress in the days running up to Christmas. Looking into 2018, the consensus is that markets could continue to grind higher despite still high political uncertainty. In the absence of recession or a rapid rise in interest rates on the back of a surge in inflation, valuations are full but not excessive, and they could stay that way this year. What does seem likely, however, is that the remarkable lack of volatility in 2017 will not last. The VIX index, which measures expected volatility in the stock market, is at its lowest level since the index was launched in 1990. Many market watchers expect some sort of a correction this year. Having not seen even a 5% retrenchment in 2017, that does seem likely. Now, this is a time of year when investors talk about the January effect. This is the theory that as January goes, so goes the year. In other words, if markets rise in January, they will continue to do so from February to December. And if they fall in the first month, that will set us up for a disappointing year. Well, the evidence is mixed, but it does suggest that around 80% of the time, a good January does lead to a good year, so fingers crossed. Yesterday, the US was up and the UK down, so no clear indication of the direction of travel just yet. Although the worst political fears of 2017 proved false, the year ended with ongoing uncertainty. Germany is struggling to put together a coalition government, creating a lack of leadership in Europe's biggest economy. The forthcoming elections in Italy and the ongoing Brexit negotiations provide further opportunities for upsets this year. The other dogs that didn't bark in 2017 but might in 2018 include geopolitical risk in Korea and Iran and a trade war between the US and China. And that's before we've even considered the ongoing economic inequalities that triggered the shocks of 2016, Brexit and Trump. With stubbornly low wage growth, job insecurity and slowing economic growth in some areas, the calmness of the markets does seem at odds with what's going on in the non-financial world. The challenges facing the UK economy in particular were highlighted by the Financial Times' annual survey of economists this week. Just over half of the 111 economists questioned by the paper expect growth to be no higher than 1.5% in 2018. The consensus is that business investment will remain on hold, that interest rates will start to creep higher, and that indebted consumers will curb their spending as inflation remains higher than earnings growth. The main focus at home remains Brexit negotiations, with most economists relieved that recent progress towards a transitional deal makes a no-deal cliff edge look less likely. But many remain concerned at the slow rate of progress and the weakness of the UK's negotiating position 18 months after the EU referendum. Other expectations for the year ahead in Britain include a falling back in the inflation rate as the year-on-year currency comparisons become more favourable, and a modest rise in UK interest rates with 1 or 2 quarter-point hikes. Looking into 2018, here are some other questions that we will have answers to in 12 months' time, but which are currently known unknowns. First, will Theresa May still be Prime Minister in a year's time? Well, 6 months ago, the odds would have been very long on this being the case, but increasingly it looks as if no one else really wants the job in the run-up to Britain's exit from the EU in March 2019. Next, will the Republicans lose control of Congress in the midterm elections, and will impeachment proceedings begin against Donald Trump? Well, the first is pretty likely, and that would make the second entirely possible. Making predictions about the US politics today is fraught with danger, though. Will China continue to muddle through with predictable growth of between 6 and 7%? Probably. Will US Treasuries yield more than 3% by year end, finally killing off the 30-year bond bull market? Possibly, with 3 more rate rises expected from the Fed this year and increasingly little liquidity support from other central banks as the ECB, the Bank of England and the BOJ all step back from their recent stimulus. Will oil end the year above $70 a barrel? Quite likely, although don't discount the likelihood of US shale stepping up to push production higher and the oil price lower. And finally, wither Bitcoin. As expected, the introduction of futures trading in the cryptocurrency just before Christmas triggered more volatility and made it easier for investors to bet against what previously had been one-way traffic. And when my 17-year-old son came back from a New Year's Eve party saying that a friend had told him to buy Bitcoin, it confirmed my view that this is a classic speculative bubble. And don't forget the big sporting unknown in 2018, who will win the Football World Cup? Brazil and Germany have won 9 of the 20 previous tournaments between them, and the home team has won 6 of them. But Russia, this year's host, is the lowest ranked team, so that seems unlikely.